Hello and welcome back to another video lecture series for Introduction to Financial Accounting Principles. In this series of videos, we're going to talk about Chapter 6. Now, Chapter 6 really deals with accounting for inventory. So as we go through this chapter, we're going to be introduced to a number of inventory accounts. And we're also going to see how exactly how merchandisers or merchandising companies account for their inventory. So we're going to look at things like FIFO, LIFO, average cost, and we'll do some calculations or we'll calculate inventory under each of those scenarios. So in this video, I want to talk about inventory concepts and how do companies actually practice inventory, okay? So all through Chapter 5, we dealt with merchandising companies, and hopefully it's clear that merchandising operations really deal with one type of inventory, right? Finished goods. It's all inventory. They buy finished products from maybe from wholesalers or maybe from the manufacturer themselves. They're finished products. They hold that inventory and they hold it for resale, right, to maybe other wholesalers or to the individual public. Now, we talked about manufacturers in the last chapter very briefly, right? We said manufacturers take materials or take raw materials, they process them, and then they turn them into finished goods, okay? Which then are sold to, wholesalers or maybe even directly to retailers. It all depends. Now, when we're looking at the manufacturing company, they actually have three types of inventory accounts. They have raw materials, work in process, we call that WIP inventory, and they have finished goods inventory. Now, raw materials inventory is pretty much what it sounds like. It's raw materials. These are items that are going to be used in the production of a product, okay? Take, for example, a company that makes bicycles, right? I don't know, Mold. I just remember Huffy. I don't even know if they're still around. So a company that makes bicycles, or think about a company that makes shoes. Let's go with the shoe example. That's pretty good. So a shoe manufacturer is going to get raw materials, right? That raw material could be leather. It could be rubber, right, to make the soles of the shoes, cloth, whatever. Okay, now let's go with this leather example, right? There's going to be another company out there that actually harvests the leather. They dry it, maybe they color it, put some coloring into it or whatever, okay? That company that actually makes the leather and turns it into a finished product so it can then be used to become maybe like the upper part of a shoe. That's still raw materials, okay? So when you're thinking of raw materials, we have to expand our definition. It's not just things like, chemicals or sand or minerals or, whatever goes into making a product. One company's finished good can become another company's raw material. Let me give you another, probably, hopefully better example. Let's think about Sony, right? Sony makes radios, okay? They get all the parts that they need, right? The buttons, the knobs, the transistors, the wires, all that other good stuff, and they make a finished product, a radio, right? Now, that radio, maybe Sony sells a bunch of radios to Ford or Chevy or any car manufacturer, okay? To that car manufacturer, that radio is a raw material because it's going to become an integral part of that finished product, which is going to be the vehicle, the car, the truck, minivan, whatever, okay? Work in process is an inventory account, and that that work in process inventory account holds all the partially completed items. Okay, so let's continue with this example with Ford. Okay, Ford makes trucks, cars, whatever. So they have a lot of input that goes into those automobiles, right? Windshields, glass, radios, engines, tires, all that stuff, right? So what we're saying is, as we're building these cars, there's costs that are associated with those partially built cars, right? Those costs show up on our work in process inventory account because these cars are in process of being built. They're not 100% complete. They need more parts, more labor to become finished goods. That's the account that holds all those costs, okay? Once the product is completed, meaning all 4 tires are put on the car, the windshield's in, the engine's in, the radio's in, the speakers are in, it's then finished. Well, where does it go? Well, obviously it goes to the holding, the shipping department, or the sits on the lot waiting to get shipped. But at that point in time, from an accounting perspective, we call that finished goods inventory. So finished goods inventory are all the costs of inventory that are completely manufactured and they're ready for sale. Okay, so you're going to need to definitely know the difference between all 3 manufacturers' inventory accounts. So how do we manage inventory, right? And again, from this perspective, we're really looking at it from a manufacturer's point of view, right? A manufacturer has to get a bunch of raw materials in, aka parts that are going to become an integral part of this product that we're making. How do we manage our inventory, right? Well, there's 2 methods we have. We have just-in-case inventory and we have just-in-time, okay? If you ever have an opportunity to dive a little deeper into just-in-time inventory, it's amazing. It came from the Japanese. There's a whole story behind it. It's amazing, right? Well, anyways, when we're talking about just-in-time inventory or just-in-time manufacturing, what this allows us to do is it allows us to keep a minimal, very, very minimal amount of inventory on hand. In fact, just-in-time manufacturing or just-in-time inventory really negates us having inventory, okay? So what we do is, by having just-in-time inventory, we eliminate a lot of the costs of holding inventory, and we have very, very minimal amount of inventory on hand to use, okay? Basically what happens is when an order comes in, meaning we order raw materials to make cars, whatever the material is, tires, whatever, we order just enough tires for the cars that we're making, okay? The problem with just-in-time inventory or just-in-time manufacturing is that it is very difficult for us to determine or to obtain the full just-in-time inventory, okay? Meaning there's no room for error here. Just-in-case inventory is a lot different. Just-in-case inventory says that, you know what, we're going to have a little buffer of inventory just in case something happens, just in case there's some unexpected problem. We have enough inventory on hand, okay? Maybe we order extra inventory, meaning we assume or we plan to make 1,000 cars this month or this quarter. Let's go with a quarter. 1,000 cars this quarter, okay? We make sure that we order obviously enough to make 1,000 cars, but we order a little extra just in case something happens, right? Just in case some of the inventory that we get in is maybe damaged or something, we have extra, okay? Now, with just in case inventory, this can be very costly for us. Why? Because we need insurance, we need a place to store it, we have to invest in things like like an inventory area so we can keep track of all this inventory. We need insurance so Obviously, we don't, you know, we hinge against the risk of losing that inventory. We need to hire people to manage that inventory. So there's a lot of costs that are associated with just in case inventory. Okay. Now we talked about this last chapter, free on board shipping and free on board destination. Just recognizing who maintains a ownership and who covers the cost of shipping, right? So when we're talking about goods in transit, meaning we got finished goods going from one location to the next location as a result of a sale, right? Let's say Dick's Sporting Goods buys shoes from Nike, okay? Well, we need to know, is it FOB shipping point, FOB destination? So that way we can keep more, we can keep better, accurate inventory records, okay? So remember from last chapter, FOB shipping says that the buyer assumes ownership at the time the goods are shipped from the seller. And remember, in this case, free on board shipping or FOB shipping point says that the buyer is responsible for those shipping costs. FOB destination says that the seller maintains ownership until the buyer actually takes possession of those goods, meaning as it's in transit, if it's FOB destination, guess what? That seller technically owns that inventory, and we need to include that inventory that's on the road being shipped to the buyer in the inventory account of that seller, okay? Free on board destination says that the seller will maintain ownership as well as pay the shipping costs, okay? So last chapter, we talked heavily about a lot of the examples that we did pretty much revolved around the perpetual inventory system, right? Constantly updating our inventory records after every sale. We mentioned periodic inventory system, says that periodic inventory system, we keep track of everything basically at the end of the period. At the end of the period, the year, quarter, whatever, we have to do financial statements. We then go ahead and count all the inventory that we have on hand, and we calculate that cost of goods sold. So any inventory system that we use, whether it's periodic or perpetual inventory system, we're always going to take a physical count of the inventory, okay? We always want to know how much inventory that we have on hand. So we know how much we should have on hand, but we're actually going to determine how much we actually do have on hand. So the actual inventory that we actually have on hand versus what our records say may differ, right? They're going to differ for basically 3 reasons. Number 1, theft. Somebody's stealing our merchandise. 2, spoilage, right? Maybe we don't see this too much in retail, but in grocery stores, right? If the milk goes bad, they can't sell it, right? So that's what we mean by spoilage. Errors is another reason why the actual inventory we have on hand versus what the reports say differ, is because, maybe somebody made an error, right? Maybe somebody put 10 instead of 100, or somebody transposed the number. Instead of typing in 12, they typed in 21, okay? So let's look at, what do we do when we physically count the inventory? How exactly does that work, right? Well, instead of actually counting everything, updating our records continuously after every sale, we wait to the end of the period. Okay, so let's look at an example here of kind of an adjusting entry that we need to make. Whether we use periodic or perpetual inventory system, we're still going to have to make an adjusting an adjusting transaction to account for any errors, right? So let's look at the example here. Savannah Company maintains a perpetual inventory method, right? They're doing it. They're constantly updating their records. At the end of the year, they're going to take a physical account. Savannah discovers that the inventory counts show $800 more than the physical inventory. Okay, so they actually have more inventory on hand than what the records say they should have. Okay, we need to make an adjusting entry. Well, let's think about this. We actually have more on hand after we counted than what the inventory says we should have. So on our books, aka the inventory that we should have, is too low. We need to bring that up to match the actual physical count. So we're going to increase our inventory, decrease our cost of goods sold. Okay. Vice versa. What do? Well, like in this example, right? They discovers that the inventory count shows $800 more than the physical inventory. So that means that their books say they should have X. Physical count says they have Y. Okay? Well, guess what? What they have is actually more, or I'm sorry, what they have is actually less than what they should have. So their inventory, just like this example says, their inventory is actually too low. Their records are too high. They need to bring their records down, so they need to do an adjusting entry. They're going to credit their inventory to bring it down. They're going to they're going to debit their cost of goods sold to bring it up. Okay? When we come back in our next video, we're going to look at FIFO, LIFO, weighted average cost, or specific identification. That's the inventory costing that we use. But keep in mind, what we really talked about in here was we introduced the 3 new inventory accounts that manufacturers have. We talked about just-in-case inventory versus just-in-time inventory or just-in-time manufacturing. We reviewed the ownership, right? FOB shipping, FOB destination. We talked about the importance of doing a physical inventory account and why might the physical inventory account or the physical inventory count not match our inventory accounting records. We have basically 3 main reasons, right? And then remember, if those 2 numbers don't match, we have to do an adjusting entry, meaning if what we have on hand is less than what the accounting records say, then we need to bring our accounting records down. If the physical account we have more than what the inventory records say we should have, we need to bring those inventory records up. Okay? So tune back in for our next video when we look at LIFO, FIFO, average cost, and specific identification.